dia a todos. Muito obrigado pela presença de vocês na terceira edição do Global Managers Conference, principal evento da área de Third Party Distribution do BTG Pactual. Durante nosso evento, vocês poderão conhecer um pouco mais de alguns dos maiores e melhores gestores globais selecionados pela nossa área. Lembrando que todas as apresentações são gravadas e que a qualquer momento podem ser acessadas em nosso canal do YouTube. Confira lá, caso você tenha perdido algum gestor que já tenha participado nesses últimos dias. Para esse quarto dia de conferência, trazemos um tema que nunca sai do radar dos investidores. China, a próxima classe de ativos? Para nos ajudar a responder essa questão, nossos convidados de hoje são Mr. Mark Mobius, fundador da Mobius Capital Partners. A Mobius é uma gestora de ativos de mercados emergentes e oferece uma abordagem inovadora de private equity para mercados públicos. Brian Ahern, CIO da KraneShares. A Crane é uma gestora de investimentos de ETFs, com um conjunto de ETFs focados em China. A Crane oferece aos investidores soluções para capturar a importância de China como um elemento essencial dentro do portfólio de investimentos. E Mike Shiao, CIO Asia ex-Japan da Invesco. A Invesco é uma empresa americana de gestão de investimentos e possui filiais em mais de 20 países, com mais de 1,4 trilhões de dólares em ativos sob gestão. E para nos ajudar, a moderadora desse painel, convidamos Laura Gonzalez, Global Head of Wealth Management da Allfunds. Muito obrigado a todos e agora passo a palavra para você, Laura.
Muito obrigada, Felipe, pela introdução. Muito obrigada ao BTG mais um ano pelo convite. A Global Management Conference já virou a referência do mercado internacional no Brasil. Good morning, everyone. I am so happy to be surrounded by such a group of experts today. Good morning, Mr. Mark Mobius. How are you?
Good morning.
Welcome on board. Mark was already introduced by Philippe, although he doesn't need to. We all know him. He's a wealth of knowledge in emerging markets, and BTG has an exclusive agreement with Mobius Capital Partners for their emerging markets equity fund. This flagship currently has around 40% allocated in China and Taiwan, so very correlated to our discussion today. We also have with us Mike Shiao, representing Invesco, Asia CIO. Good morning, Mike. How are you?
Good morning, everyone, and welcome to the conference. Thank you, Laura. Thank you.
Welcome on board. I know BTG has very recently signed an agreement with Invesco. I actually saw that on the press yesterday, so congratulations on that. And I know you will be talking about Invesco's Greater China Equity Fund, which is actually the fund that BTG will be exclusively representing, so very pertinent topic. Thank you for your participation today.
Thank you very much.
And last but not least, we have Brendan Ahern. Brendan, good morning. How are you?
I'm doing excellent, Laura. How are you?
All good here. Thank you so much. So,
good to hear.
Brendan, you are KraneShares CIO, and KraneShares is a very unique concept because it is the only ETF manufacturer that is focused on China. Is my understanding correct?
Yes, we're focused on the new China, new economy thematics, things like internet, healthcare, 5G, as well as the opening of China, providing access into the Chinese A-share market.
Brilliant. So we have a winning combination today. We have active, we have passive, we have Mr. Mark Mobius, who is a true legend. So I think it's going to be fun, right? I was taking a look at one of HSBC last reports on China last week, and something that draws my attention is the fact that China is already the first global economy by some metrics. If we take a look at research and development, China has already surpassed the US, and that is quite a big thing to say, right? And I would like to kick off the panel taking a look at that. There are some consultants claiming that China will overtake the US by 2028, and that is also something that is quite remarkable. And I would like to kick off with you, Brendan, because in this comparison between China and the US, it's all about the metrics somehow. If we take a look at the GDP, China already represents 16% of the world's GDP versus 25% that is represented by the US. And likely, in terms of capitalization, China is still below 10%, when the US is almost 50%. So my first question addressed to you is, how is China in the process of becoming one of the major asset classes for investors with this diverse landscape in mind?
Yeah. Then certainly economically, we know China is very, very large, second largest economy in the world. On a purchasing parity perspective, it's already larger than the United States. But I think for investors, it's important to recognize that 20 years ago, China was 6.5% of MSCI emerging markets. By 2010, it was 17%. Today, it's 40% of emerging markets, and there's a path for it to be 50, 60% of MSCI emerging markets over the next 5 to 10 years. And so I think, investors are going to need a friend in the China business simply because navigating its economy and capital markets, and that's where hopefully KraneShares, we can earn the trust of investors. At the same time, we see this as a tremendous opportunity. Already investors are acting. I pulled up the latest data. Year to date, over $35 billion of net inflow into Chinese this year. Over the last year and a half, that's over 66 billion of net inflow into Chinese A shares. And so I think it's happening, that this idea that China is going to become an asset class, just as Asia ex Japan is considered an asset class. The size and scale of China is so large that we're going to have to break it out. And we're seeing U.S. institutional consultants, Cambridge Associates, Mercer, Makeda, are actually advocating that investors take a dedicated China stake. And we believe at KraneShares that investors should be doing the same. And that can be putting great managers like Mark and Mike to work. We also think that there is a beta element to the market, and that there's a role for passive, both either on the thematic or broad exposure. So certainly China as an asset class is certainly coming, and investors need to prepare for that.
Thank you, Brendan. Mark, would you like to add the active component to the very same question?
I think Brendan is right on target. He's absolutely right. You really need a mix of both active and passive. And as you know, in the last 5 years, the ETF market has exploded in the US. And by the way, in other parts of the world, even in Hong Kong, you now have ETFs reflecting what's happening in China. So that's a very, very important point. The other point to be made is that China is, in the long run, is looking at the US. And if you look at the actions that the government in China have made, you can see that they have looked at the US and said, look, we want to have a system, a market system like the US, because we realize that the US has succeeded as a result of their market economy. So we don't want their political economy, but we want their market economy. So what they're doing now is saying, we have to open up the market. We have to become a major capital market like the US, and maybe even bigger than the US. So as Brendan has been saying, the growth in the capital market in China is going through the roof. When we started in 1987, China wasn't even on the map. It was closed. It was a closed country. So we've seen this incredible explosion in capital markets in China, and this will continue. And you must also remember that although the US dollar is now the reserve currency around the world, the renminbi, I believe, will eventually become a major reserve currency, and maybe even the largest reserve currency in the world. And that is, again, the target that the Chinese have in mind, because they realize that in order to be a major economic power, they must have control of the reserve currency. So a lot of exciting things are happening going forward.
Thank you, Mark. We have just talked about capitalization, and we cannot miss a valuations chapter here. I'm sure we have many people doing fan picking in the room, and they are wondering why Chinese companies are priced at such a discount versus its US peers. Mike, could you elaborate on that? What is the reason behind?
Well, I think the Chinese equities now are trading at the end of May, probably around like 28% discount to the US. And actually, if you look at the Chinese companies, their earnings are much stronger than a lot of US companies in the next 1 year at least. especially in the consumer discretion, consumer staples, healthcare, and information technology, sectors. I think the key reason is partially because of a lot of investors. They actually overlook China because as the first the question that you asked about the market cap versus the GDP, China is actually underowned in a lot of people's portfolio. And for example, the A share actually has a market cap about 20 trillion, but in the EM index is only about 5% versus the offshore listed Chinese companies in Hong Kong, which is about 5 trillion of the market cap, but it actually represents about 34% of the index. So I think China overall is underrepresented, underowned, and then that is why even Chinese companies, they look like going to deliver very strong earning growth outlook in the next 1 or 2 years. Still missing from a lot of people's portfolio, and I think that's part of the reason that China is still trading at a discount to the US. But we do see as more allocation. I think Brandon and Mark also mentioned that into the Chinese equities, that will help to narrow the gap.
Thank you, Mike. You mentioned a few aspects that are very pertinent. We hear quite often that lack of transparency could be playing a role when it comes to discounted prices. Brendan, you are the master of the universe in Chinese passive, so let us know what you think in this regard.
Well, I think, one of the things about China we find with investors is, if we read the Wall Street Journal or the Financial Times on a daily basis, we're just bombarded with negativity. And I think a lot of times the perceptions of China are formed without looking at the data. So one of the things you had mentioned, Laura, is China's urban middle class spends $7 trillion annually. And that's a significant amount of money. And at KraneShares, we've been very focused on the Chinese internet companies. KWeb is kind of our flagship ETF. Really focused on the internet companies, which are the transmission engines for domestic consumption. But I find that investors, they think about China, and yet they don't back up their views with the facts by looking at data. And I think when we look at the data provides, as Mike mentioned, a very, very compelling opportunity from a valuation. So today, U.S. internet stocks trade at a PE of 42, at a PEG ratio of 2. The KWeb companies, which are amongst some of the fastest growing companies in the world, are at a PE of 25, and the PEG ratio is now below 1. And so I think, in finance, everything we do is supposed to be about the data. But when it comes to China, we're driven by perceptions, opinions, and the media. And I think that's a great disservice. You have to look at the data and the facts. And I think that data provides why we believe it's a very, very strong opportunity to be investing in China today. Because a lot of U.S. investors, to Mike's point, I think don't get it. They allow their own misperceptions to allow them to avoid potentially a very, very strong opportunity.
Thank you, Brendan. And talking about valuations, Mark mentioned something before that is very, very interesting, and it's what's going on in China from a regulation standpoint. We have seen that the regulators seem to be concerned about excessive valuations, right? And about markets that can be overheated. So we have seen action on the tech bubble, same applies to commodities. We have more recently seen what has happened with cryptocurrencies. My question to you, Mark, is what do you think is going to be their next shot? Do you think it's going to be real estate? Can we expect further action from regulators in China? What are your thoughts in this regard, Mark?
I think the regulators in China are looking at all sectors. And you must remember, again, going back to the example of the U.S., the U.S. has anti-monopoly laws, unfortunately not very well applied, but they have these laws. China also realized that they have to go after monopolies and break up companies like Alibaba, like Tencent, so forth, who dominate a certain sector. It doesn't mean you're going to destroy these companies. They want these companies to succeed, but they also want smaller players to to be participating. So you're going to see a lot more of that kind of action on the part of the Chinese regulators. They're going to be much more aware of dissonance in the market where one company dominates a certain industry to the detriment of the smaller players. But the other point I think very important to remember is that when people begin to first look at the balance sheets of Chinese companies and so forth, they see Chinese characters and they say, what is this? They don't understand it. It's not English. That has changed. Most of the companies now in China have English translation and audited financial statements. And I've seen an incredible sea change in the attitude of the managers. I remember many years ago when we went to one of the major state-owned enterprises, they didn't want to say anything. They couldn't say anything. They were very, very careful about anything they said. Then recently we went to see a Chinese company and I was shocked because the chairman came into the room with his directors and said, first of all, I want to tell you, I want to apologize for us not being so friendly to shareholders. And we'd like to answer any question you may have. This is a sea change in attitude on the part of Chinese companies. And by the way, this is a government-owned company. So the government has really put out the message is they want good corporate governance, they want transparency, and they want to go after monopolies that are suppressing smaller companies, which I think is probably a good thing.
Thank you, Mark. Mike, are you in line with this view? How would you say that regulators are acting these days?
Yeah, I think definitely Mark's point is very accurate, especially in terms of how the regulator is paying attention to some companies' monopoly power. And I think Brendan also mentioned previously, like investors, they don't really see the fact that they kind of take it from their perception, thinking that the regulator is always like to intervene. But I mean, like a lot of people ask about, for example, Ant Financial. And I think the timing for the regulator to step in may be not perfect, but definitely, I mean, if we understand where they are coming from, and we definitely can appreciate the effort they are trying to prevent anything which can eventually shake the society as the business is not well regulated and become too big. And similarly to what Mark's point, I think, for example, in the Alibaba's Taobao platform, you basically cannot use Tencent Pay. You can only use the Alipay, which create a kind of exclusivity to Alibaba Group, and really, create a conflict between the company and also the average consumer, benefit. So I think definitely the regulator is moving towards a very, right direction. And if we don't over-interpolate because our kind of a very stereotype perception, I think definitely, you will feel it makes better sense. I mean, it makes a lot of sense for the regulator. And lastly, I want to mention is, yes, I think China is now paying a lot of attention to this overheated, crypto commodity price, which is also consistent with the economic approach that they want to have a stable economic growth rather than, the boom and bust type of economic growth.
Thank you, Mike. So it seems to be that there is some consensus around the fact that it is a healthy degree of intervention. Brendan, you agree on that?
I think, the Chinese government job one is stability. That they, similar to the emperors of yesteryears, you want a strong economy. You want people to be happy, an opportunity to raise themselves up. And I think the government intervenes to Mark's point where they, and as well as Mike's points around where they see the companies don't necessarily aligning themselves with that objective. And ultimately, the government has some involvement, but I think, the view of the government, I find people think the Chinese government is some sort of James Bond, that it's this all-knowing, all-encompassing. And when you're in China, you don't feel that. And I think for the companies, yes, they have to play with the regulator, play along. but it's a government, no different than a government in Brazil or Chile or Peru. This is not some all-encompassing superpower. It has some involvement, no different than here in the United States. You can see the new head of the FTC. She has some very, very strong views about the monopolistic prowess of U.S. technology companies, and the same is true in China. The same is true in Europe. We've adopted these technologies in such a vast way that we haven't really thought about some of the consequences. So ultimately, these Chinese internet companies in particular are the golden goose. They allow 30% of all retail sales happens through the companies we hold in K-Web. And domestic consumption is part of job one in China. And no one kills the golden goose, and because they lay the golden eggs. And I think, yes, these companies are going to be regulated, but they're not going out of business. And we saw that in the Q1 earnings. Alibaba, despite all the noise, revenue growth 64%, Tencent 25%. This newer Bilibili almost 70%, Pinduoduo almost 240% revenue growth, and that's created. Investor sentiment is very worried about this issue, but I think they're pricing the companies as if they're going to go away, and we vehemently don't believe that's the case.
Thank you, Brendan. I think that if we are talking about regulators' actions and concerns, we cannot disregard what's going on with the currency in China, right? Because we recently saw the strongest level for the yuan in 3 years, and the Central Bank of China has also increased reserve requirements from 5 to 7%, right? I'm going to address this question to you, Mike. You think this is a clear sign that they will not further allow appreciation of the currency?
Okay. Well, the renminbi actually strengthened about 10% against the U.S. dollars in the past year, and hit a 3-year record high in May. But I think there's a fundamental reason. The renminbi's jump, I think, is mainly coming in response to China's quick economic recovery from COVID-19, and especially the export sector has been performing very well in the past 1 year. And also the strong inflows to China's rapidly developing bond and equity market, where I think we all talk about is the ownership from foreign investors are still making a very small portion. But we do feel that the policy makers, they have grown concerned over these rising property price, the hard money coming into China, rally in the currency, and as well as the recent volatility in the commodity market. So we do expect that China is going to allow more investment to flow out of China through different schemes and programs, such as the QD and also the Connect. Longer term, I think China will try to keep the currency stable and gradually open up the capital account to support renminbi liberalization.
Thank you, Mike. Mark, what would you think could be a reasonable range for the yuan to be expected over the next, let's say, 12 months?
That is a very difficult question to answer. Very dangerous question. 7, 7.8, whatever. You can pick any number. But in line with what Mike has just said and what Brendan has said, what does the Chinese government want? They want stability. They don't want to have a currency that's jumping all over the place. They want a currency that be relatively steady against the US dollar. And as I mentioned before, this is in preparation for the currency to eventually become a reserve currency. If you have a reserve currency, you want a high degree of stability. And by the way, the interesting thing, as Brendan mentioned, this is not a country where everything is all the same and everybody does the same thing. There's a tremendous amount of freedom and movement in Chinese economy. And that goes for the currency, because you have, on the one hand, the central bank that wants to have control of the currency. And then you have, on the other hand, the people who are controlling the market or looking at the market, regulating the market, wanting to have more inflows and more freedom in the currency. So these contending forces are always at work. But the bottom line is that they will always opt for a steady currency. So you are not going to have more than 5 or 10% movement in any great period of time. And you've seen that. You've seen the appreciation of the renminbi. But again, as Mike has pointed out, the government now is allowing more money to go out of China. Why are they doing that? Of course, they want to bring this currency down a little bit, make it a little bit more weaker so that it doesn't get completely out of control. So I don't think you're going to see lots of volatility.
Brendan, would you like to jump in?
Yeah. I think Mike and Mark make great points now. One thing that we've noticed is Mike mentioned this QDII program, which allows Chinese money to go outside of China to invest overseas. Now, what we find very interesting is there's an ETF in mainland China that looks eerily similar to KWeb, it's basically the exact same fund as KWeb, and it's part of this QDII program, and Chinese investors are throwing money at this. The beginning of the year, this fund, the ticker is 513050. So you can check check the data. We always want to look at the data. That fund had under $1 billion US at the beginning of the year, and today it's over 3 billion. The shares outstanding went from 2 million shares to 10 million shares. So why is that important? To us, it shows that the investors in China believe that the companies that we hold in KWeb are a great opportunity. That when they have this opportunity to go invest outside of China, they're doing it in a fund that holds these Chinese internet companies, arguably the best companies in China. And to me, that's very reassuring that the people who use these companies' services on a daily basis are buying the stocks hand over fist. And I think that gives us a lot of confidence that these companies aren't going away because the investors in China wouldn't be buying them.
Thank you, Brendan. You are referring all the time to something that is very interesting, and is the fact that we need to distinguish between perception and data. And actually, the next chapter I want to initiate now is demographics, something that in China is perceived in a very particular way by the broad audience, right? Demographics is a hot topic these days in China. Well, it has always been the case, I would say, but it's true that China has changed its birth rates policies, right? And I'm going to address this question in first place to Mark, because it seems to be that China is facing quite a remarkable demographic problem these days. And my first question is, to which extent is that real, Mark?
There's no question that you have an aging population in China. As you know, the one-child policy created a sort of a bump in the population pyramid, and that now is coming home to roost, which is why the Chinese government now is encouraging more births. They're saying you can have 2, you can have 3, and so forth. So it's definitely a challenge that they see coming forward. But don't forget, China is not the only country that's facing that bulge. The U.S. is facing the same thing. Of course, it's ameliorated to some degree by immigration, but this is a long-term trend that countries in the developing world, look at Europe, you have the same kind of trend where there's an aging population, not only because of fewer children being born in the past, but also because of longer lifespans. People in China are living longer. So this begins to encourage us to look more at the medical area and areas in the economy that will be taking advantage of this aging population phenomenon. And of course, in this area of technology, medical technology is becoming more and more important. And now, of course, with the advent of COVID and all of these other viruses, you're going to see much more emphasis being put on medical care in China. So it's not a problem as far as I can see. I think it's an opportunity. You have an aging population, that's fine, but then you have opportunities as a result of this aging.
Thank you, Mark. Mike, would you say that there are like proper measures in place? I've heard that raising a child in China is not the most affordable thing on earth. What are they doing to, promote a change in this regard?
Well, if you look at the country around in Asia, I think you'll find like Korea, which probably is the lowest birth rate in the world. I heard about this, and Singapore, Taiwan. I think these, places, they are all encouraging people to have more kids. But, like Laura, you pointed out, it's nowadays become less affordable. If you have, many kids, you need to send to college and etc. But I think, again, it's a perception versus the fact or the data. From this headline, yes, it's a big decrease of the workforce, 6.7% decrease in about 10 years for the working force. But I think in the meantime, we should also, first of all, I agree with, Mark's, view about the consumption is actually not or very minimum or very little impacted because people are living longer and the healthcare is part of consumption. People looking for a different lifestyle, etc. But on the other hand, I think from the workforce perspective, we also notice that actually the labor productivity is not, as what you are thinking. Is actually not what we are thinking. Is actually continue to improve. So that kind of offset the decrease of the workforce. Now, for example, China pay a lot of attention to the education, and then which in turn actually help the productivity. So we found that people aged 20 to 39 who have received some kind of a higher high school education or college education actually more than doubled in 10 years from 10% to 26%. And also the automation, I think, is also something we noticed that the Chinese manufacturing sector, the usage of the robot actually increased 7 times during the past 10 years period of time. So I think all these is actually helping to offset some of the pressure from the decrease of the working force. Thanks.
Brendan, any objections to that or fully in line?
No, we definitely see healthcare as an opportunity. It's an area we've been invested in for over 3 years with a dedicated China healthcare, really driven by the demographics, as well as just as China gets richer, people want to take care of themselves. The adoption of a Western diet has had a very unfortunate consequence with the rise, particularly of diabetes. Still very high smoking rate amongst men. Women are definitely smarter, has proven that women in China don't smoke, but men do. So we see a tremendous opportunity around taking advantage of the demographic trend in China. At the same time, I think there's over half a billion millennial and Gen Z population in China today. This younger generation has very different views about spending. They're more apt to take on debt. They're more apt to spend. That this might not necessarily be a good thing in the long run, the adoption of credit, but at the same time, it certainly plays into the government's policy of trying to raise domestic consumption in order to alleviate export-driven manufacturing, making them dependent on other economies. So the service sector already in China is more than 50% of GDP. And consumption is a big part of that. So yes, there are some demographic headwinds in the long run. At the same time, there is a very large younger generation, those born after 1980, over 500 million people. That's a big number. That's a big consumption market.
Great. I would like to initiate another chapter, completely different subject actually, but it's also a trending topic, and it's ESG, right? Because nowadays we are seeing a global trend towards ESG. This is quite obvious. In Europe, what we have seen, it's a regulatory tsunami, right? There is a taxonomy in place, new transparency rules, new reporting requirements, many things going on. And I would like to initiate this discussion with Mark Mobius, because I know that Mobius Capital Partners has been really into the ESG since its inception, right? And nowadays it seems to be that everyone is ESG, but I know that Mark was into that since day zero, right? So what I would like to ask to him is, how do you see this global trend that is so massive in first place? And secondly, I would like to know to which extent this ESG component is still underdeveloped in China. So 2 questions in one. Hope I'm not inundating you, but I would like to have your thoughts on these 2 items.
Well, first of all, ESG is definitely with us. The environmental, social, and governance areas are very, very important to our clients, to us, and to anybody in the business. You can find every company we talk to in China, in Taiwan, in Korea, in Turkey. They're very much aware of the ESG components. And as you pointed out, our foundation of our fund has been to promote better ESG plus C culture. In other words, the culture within the company. So when we invest in the company, the first thing we ask is that, are you willing to engage with us to help you improve your ESG component and your C component? And if they're not interested, then we don't invest. So this is very much in our mind. And China is no exception. China's companies are very aware of this. One of the reasons why they're aware of it is because investors and customers are asking about these issues. The young people in China are very much aware of this situation. Of course, the government is also aware of it. But the interesting thing is that when we sit down and begin to look at ESG, we begin to think, well, wait a minute, this is not very much different than what we were doing from the very beginning when we started in 1987 with emerging markets, because every time we looked at a company, we had to find out if they were doing anything damaging to the environment, because it could get them into trouble with their clients or with the community. We had to look at what they were doing socially, whether they were making enemies within the social environment. And of course, governance was very much uppermost in our mind because we wanted them to be treating us as shareholders fairly. So what's happened is that the components have not changed. In other words, the desire for these improvements have not changed, but they now have been categorized and put into a form that people can now follow, a list of items that people can follow. And you're going to see more and more of this as we go forward. And no company in the world will be able to escape from the ESG trend. No question about that.
Thank you, Mark. Mike, as Asian CIO, what is your forecast for ESG in the region?
I agree with Mark's view, and I think definitely ESG is now getting a lot of attention. It's not just from really. I mean the push to everybody to comply with a lot of very good standard of ESG is actually coming from all fronts. For example, we are running the mutual funds, and in Europe recently there's a regulation SFDR that try to categorize the fund in Article 6, A, and 9. And a lot of investors, like in Brazil, Europe, they are asking for your fund to really show very good score of ESG. So, and in the meantime, I think Mark mentioned about, in China, it's not just from, the investor. I think the government is pushing it. For example, we have this one of the entity in Shanghai, and which is the WUFI, the wholly foreign-owned entity. It is a company doing the private equity, private raised equity funds. And there's an association for managing these sort of companies, and then they actually routinely ask us to about the feedback of how we do the ESG, etc. So I think it's really coming from all fronts, and I believe the standard is just going to be high and higher, and that's going to help the entire global to really cope with all the challenges from the environment.
On a more concrete note, Brendan, if I'm not mistaken, China has made a commitment to be peak carbon by 2030 and carbon neutral by 2060. How are they going to reach this goal?
Well, they have to wean themselves off cheap, abundant coal. That about 56% of electrical transmission is generated by coal-fired plants. Additionally, a lot of the apartment buildings, office buildings have furnaces that are run on coal. And the environmental consequence of being the world's factory really reached a breaking point several years ago. And the government was attuned to the general population not liking the really a very big problem in pollution in Chinese cities, particularly during the winter when you need to burn more coal for heat. And as investors, when you see policy change in China, you always want to align yourself with that policy because money is going to go toward it. So as investors, we see a tremendous opportunity around wind and solar. That wind and solar only account for about 6% and 3% of energy transmission in China. That's going to double, if not triple, over the next decade. We also see electric vehicle adoption being very aligned with this pollution, this carbon neutral goal. I think most in the United States, automotive pollution is actually now greater than industrial pollution. And so China wants to push getting adoption of EV. Last year, China sold 1.4 million electric vehicles out of about 20 million aggregate auto sales. By 2025, that 6% of all autos being EV is going to be 25%. And that's going to create tremendous opportunities for investors. We're very focused on this area. Really, solar, wind, and EV are going to be winners in our opinion over the next decade. And I think it is an ecosystem. The largest EV battery maker, CATL, most investors never heard of this company. They just did another partnership with Tesla, but CATL is going to be a winning stock. It's listed in mainland China, so it's very difficult to buy. And ultimately, our ETFs do something that's very hard for you to do as an investor, which is to buy these Chinese A shares. So we do think this policy shift is a tremendous opportunity for investors today.
Wow, we'll keep an eye on that, Brendan. Definitely will. I would like to get back to the role that China is playing more from a geopolitical perspective. And I'm going to address this question to Mike. I would like to hear Mike's thoughts on the role that China is playing from a geopolitical standpoint. We have seen some things like China deciding to increase the number of nuclear weapons. Do you think that these type of things can affect asset valuations? Could you, Mike, please elaborate on that?
Yeah, I think the China's focus was still pretty much mainly on the economic growth and keep the society stable. I think that is really China's key growth. I mean, it's really China's key focus. So we would not, for example, as an investor, we would not over-interpret these geopolitical relations or how China is, trying to, expand the military to somewhere. We purely really look at China, and we understand what is really the core concern and the focus of the government. And then when we look at the investment in China, for example, 90% of MSCI China revenue is actually from domestic market. So, I think that's really a difference between what you are seeing China in geopolitical wise, but in the meantime, when you are investor in the stock market, actually 90% of the index you are following, they have revenue from domestic consumption or domestic related rather than the export. So what I mean is even the US give China sanction, and eventually, you don't really see a big impact of the earnings. I think that's one thing. And I think also from the U.S.-China relations, we are seeing, for example, not just in the stock market, even though, I mean, we are seeing all the tensions, but I think to see is to believe. When you look at those U.S. companies' action, for example, those global financial firms such as J.P. Morgan, BlackRock, they still pour tons of money into China to acquire either the asset manager or the stake in a bank. So that actually gives us some confidence that while there's a tension, but seems to us there's also really understanding about how much this will go. And then if you look at all these big US companies, they are still investing in China. I think you actually have some kind of a peace in mind that these things were not even getting any worse.
Thank you, Mike. You mentioned something that I know the audience is passionate about, that is the tricky relation between China and the US, right? And that was actually my next question. And I would like to hear Mark's thoughts on that, because it's a broad question, but I think it's going to resonate with the audience. I would like to know how the new US administration is affecting this very special relation between China and the US. Mark, let us know what you think.
The new administration under Biden is going to soften the rhetoric that you heard by the previous administration, and relations with China will probably get better. Now, I'm not saying there's not going to be criticism in one direction or another, but generally speaking, I think the relations will get better. And if you look very closely at trade, for example, you will find that trade between the US and China has not really gone down dramatically. In fact, I think latest numbers show that China's exports have even gone up, not only to the US, but to the world. But I think more importantly is the impact that China is having in investment around the world, particularly in emerging countries. The Belt and Road projects have been very, very beneficial and have had a big impact on many countries around the world. For example, a while back, I was in Sri Lanka and I saw a beautiful new container terminal built by the Chinese. This is an example of what the Sri Lankan government couldn't do themselves, but the Chinese could. And it added a big, big plus to the economy of Sri Lanka. And you're seeing that in many, many other countries where they're building roads, airports, railroads, et cetera, et cetera. Now, the cynics might say, oh, they're just doing that for political purposes. But the reality is that the impact on these countries is quite beneficial. So, yes, there's a military competition between the US and China, and there's trade competition, but there also is going to be more competition on how each of these countries can influence what's happening in other parts of the world, particularly in emerging countries. And that, I think, will be beneficial for the world.
Brendan, do you agree with this softer approach from the Biden administration?
Yes, I think the previous administration used China as a distraction technique. It was kind of look over here and not in the mirror, and throwing China under the bus was simply that. But it was all bark. That there was no bite to it. That the U.S. and China are highly intertwined. U.S. publicly traded companies generate almost $500 billion of revenue in China annually. I think a lot of people would be surprised to learn that Texas just overtook California as the largest exporting state to China. Now, what is that? That's gas. It's LNG. Now, if we listen to Texan politicians, you would never believe that. But are those politicians really going to put hardworking blue-collar Texans out of work simply for airtime on TV? I don't think so. It's very similar to the politicians from Arkansas, some of the most vehement anti-China U.S. politicians out there. And yet the largest employer in the United States, Walmart, headquartered in Arkansas, actually owns a piece of JD.com. And that's because Walmart is doing very good business in China. The same is true Midwest. Exports of corn and soybean have never been better from Midwest farms, but yet a lot of those Midwest politicians like to throw. So it's all bark. There's no actual economic bite to it, and we can't let that distract us. Again, if we read the Wall Street Journal or Financial Times every day, you're never going to invest in China. And yet, if we look at the data, we looked at the facts, it provides a very, very different picture, and that's true for U.S. politicians.
Thank you, Brendan. I think we could spend the rest of the discussion talking about data and China, which is absolutely exciting. But I promised before that we were going to touch base on the Greater China concept, because he manages a fund that is Greater China, and I would like to know, why is this concept so attractive from a risk and return standpoint for investors, Mike?
Thanks, Laura. Yes, if we look at just the risk, adjusted return, for example, the MSCI Golden Dragon, which consists about 20-something% of Taiwan, and also the MSCI Taiwan, they actually outperform the MSCI China in the past 1, 3, 5, and 7 years. Why? I think because Taiwan market is really a good supplement to fill China market's lack of tech hardware investment opportunities. Especially China is also the world's largest market for many electronic devices. Many Taiwanese companies actually benefit from China's demand for smartphone, TV, and I think going forward for the EV, a lot of these technology things. And Taiwan equity market is dominated by tech sector. I think the semiconductor is going to have a very strong growth years going forward, given all these devices you are running need to have some kind of a semiconductor chip, and the semiconductor chip is actually in shortage. Things like 5G, cloud computing, and EV, I think these are all the things that really need a semiconductor to operate. So I think overall, to have Taiwan as part of the China investment is a very good idea. And previously we also mentioned, if we are looking at the EM, if we combine China and Taiwan together, I think the Greater China actually is very big in terms of in the EM context.
Thank you, Mike. So I highly encourage investors to keep an eye on Greater China now that BTG has an exclusive agreement with Invesco. Unluckily, we are missing a good number of questions, but it seems to be that the audience also have a few ones, and the audience want to get back to the bubble subject, right? The audience is asking whether you see a bubble in China A shares. Mark, would you like to take that one in first place?
No, I don't. I think we're going from strength to strength. And although you've seen a pullback to some degree, mainly because of the big index leaders, Alibaba, Tencent, got hit as a result of the crackdown by the government on some of their actions. We mentioned about monopoly problem. But generally speaking, the market is going to go from strength to strength. As you've heard from Mike, the valuations are very attractive, and there's no reason why the market can continue in this point. If you look at the normal length of bull markets, we're not even halfway there. So I think we're going to still see good performance coming out of China.
Thank you, Mark. We have talked about geopolitics today, about macro, about currency, demographics, but I don't think we can conclude this panel without touching base on COVID, right? Because we cannot speak of China without touching base on COVID. So, Brendan, what lessons can we learn from China and COVID? Because they were the first movers, first in, first out. What can we learn from that?
Yeah, this is where China is almost like a tell in poker, because China's a year ahead of the rest of the world. And I think one of the interesting things that we're seeing is a migration back to growth stocks that I think the investors were very focused on growth stocks, FANG, tech globally, and that was true in China. It's true in Taiwan, Korea, and the cyclical value commodity-driven rally caught a lot of investors flat-footed. So they had to fund gaining that exposure by selling their growth stocks. And I think what we see going forward is that the growth companies have the growth, that the habits formed during the quarantine have stuck. And I think we're seeing a migration now back to these growth names. If it's healthcare, if it's tech, consumer technology plays, we do see this migration coming back. And I think, on the idea of the Chinese A share being a bubble, I would vehemently disagree. The Shenzhen composite is almost back above its mid-January highs. That's still 22% below its all-time high back in 2015. And I think that Chinese A share investors in the Chinese A share market, which is predominantly investors in China, foreign investors only own about 5-6% of Chinese A shares, that those investors see a very strong economy in China. They're not going to be allowed to put as much money into real estate. So we see some real tailwinds for Chinese A shares. And the only thing I would caution to investors is that you have to choose wisely. That a lot of investors will look at the CSI 300, but MSCI's definition of Chinese A shares is MSCI China A, which is almost 500 stocks. And investors have left a lot of money on the table by investing in the CSI 300, which doesn't include mid-cap stocks. And those mid-caps tend to be private companies in growth sectors. And you could generate hundreds of basis points of alpha by just owning MSCI China A versus the CSI 300.
Thank you, Brendan. And luckily, we don't have much time left. Huge thanks to you, Mark, Mike, Brendan. I was too proud of sharing the floor with you, and I hope we can meet again next year, maybe in Sri Lanka. Mark was talking about Sri Lanka. It's one of my favorite places on earth, so I hope we can meet there next year. I will now leave the floor to my friends from BTG Pactual, to Philippe. Muito obrigada. See you soon.
Thank you very much. Thank you. Bye.
Bye now.
Thanks for the overview, Mark, Brandon, Mike and Laura. Obrigado a todos que participaram desse painel. Lembrando que em uma parceria exclusiva disponibilizamos para todos os nossos clientes aqui no Brasil o fundo Mobius Emerging Markets e o fundo Graded China Equity da Invesco. Muito obrigado pela presença de todos e não percam amanhã, a partir das 10 horas, o nosso quinto e último dia de conferência, o tema ESG, remodelando o mundo dos investimentos. Um abraço e até breve.